Good afternoon, ladies and gentlemen. Welcome to Mpact Limited's final results presentation for the year ended 31 December 2020. Bruce Strong, CEO, and Brett Clark, CFO of Mpact, will be taking you through the presentation. Should you have any questions, please submit your questions by using the question tab at the top of your control panel, which I will post to Bruce and Brett on your behalf at the conclusion of the presentation. I now hand you over to Bruce Strong.
Thank you, Mollies, and good morning, everybody, and thank you all for joining us for our results presentation today. I'm joined by Brett Clark, our CFO, and we'll go through a presentation, and after that we'd be happy to take any questions you may have, as Mollies has already said. Considering the challenging operating environment over the past year, the progress we've made implementing our strategy and the financial results are very pleasing. Through a concerted effort, Mpact achieved record cash flow, which resulted in net debt decreasing to 1.4 billion rand for the year. Underlying earnings per share increased, and the group is in a strong financial position with gearing at 27%. The successful share buyback over the past 5 months returned 345 million rand to shareholders at an average price of 13.71 rand, which is a 38% discount to NAV. We saw a strong recovery in the second half of the year compared to the first half, which was negatively impacted by the weak containerboard market and the strict COVID-19 lockdown. The group's safety performance improved, with the serious injury frequency rate reducing to a record low of 0.26 injuries per 200,000 man-hours. The response to COVID at all operations was exceptional, demonstrating the depth of good management and the effectiveness of our safety systems throughout the year. Several capital projects were successfully completed during the year, and we acquired 3 additional properties for our operations. Construction of Delisu's 280 million rand sodium sulfate processing plant at our Piet Retief paper mill was completed in December. Delisu is a black-owned business in which Mpact has a minority shareholding. The business has developed processes to convert byproducts from the paper mills into commercial products, including dust suppressants and the sodium sulfate that we have just commissioned. Jetpack's new printer was installed at the end of the year, and we completed the development of our new recycling distribution centre in Ekurhuleni, the biggest of its kind in South Africa. An additional solar installation was turned on during the year, and 2 more will be commissioned in 2020. Given the success of these solar projects to date, we're planning installations at several other premises over the next 2 years, which will take our installed capacity to over 7 megawatts in just 3 or 4 years. A number of energy-efficient lighting projects were also completed during the year, and those projects are ongoing at all operations, as we progress. At the end of this presentation, I will share some pictures with you of these projects. Mpact Operations Pty Limited, the group's main trading entity, retained its level 1 BBBEE contributor status during the year. An additional 5 students were offered bursaries through the Mpact Foundation Trust during 2020, bringing the total supported through the trust scheme to 34, of which 13 have already graduated. The group has made excellent progress against our sustainability targets over the past 5 years. Against the 2012 baseline, all of the 2020 targets for water, energy, and carbon emissions were met by the end of 2019. Though the abnormal operating conditions experienced in 2020 due to the lockdown and electricity supply interruptions did cause minor setbacks. For the full 5 years ending 2020, Mpact exceeded its water use target with a reduction of 23%. Energy consumption reduced by 14%, and the reduction in scope 1 and 2 carbon emissions reduced by 11%. Innovation remains a cornerstone of our business. Responding to our customer needs, we successfully launched a new Fresh Packed brand of paper-based fresh produce punnets, which were enthusiastically adopted by our customers. And I'll show you some photos of those a bit later. Our product excellence was again recognized with Mpact winning 9 Gold Pack awards, including 3 for COVID-19 specific product innovations. Other notable successes during the year include our response to COVID-19 and the improved domestic market in the paper business since the last quarter, which positions us very well for 2021. The devastating impact of COVID is by now clear to everybody. At the interim results, we did share details of our response to the various aspects directly affecting the business, and it will be well documented in our integrated report, which will be published towards the end of the month. So I'm not going to repeat all of that now, but I would like to take this opportunity to acknowledge and thank all of my colleagues, our customers and suppliers for their exceptional efforts and support over the past year. For me, it's been most gratifying to see how we've all pulled together with great resilience and determination, and I would say we've emerged strong. Moving on now to the financial review, and I should just make the point in the comparative. So the 2019 numbers are for continuing operations. You may recall that Mpact Polymers was discontinued in 2019 and so is not in the numbers now anymore. Group revenue for the year ended 31 December was similar to the prior year, with a 3.5% increase in plastics, offset by a 0.7% decline in paper. Sales volumes decreased by 3.8%, and I'll deal with the sales volumes in more detail as I deal with the various segments. Gross profit for the group decreased by 4.9% compared to the prior year to 4 billion rand, with a gross profit margin decreasing to 36.1%. The loss in gross profit directly attributable to the nationwide lockdowns is estimated to be approximately 70 million rand for the full year. During the year, the Springs paper mill lost more than 50 days production due to a failure of a municipal substation in Ekurhuleni, which cost the group approximately 100 million rand. An interim settlement of 35 million rand has been approved by the insurers, and the net proceeds of 25 million have been included in the results as sundry income. And the difference between the 35 and the 25 is essentially insurance deductibles. The balance of the claim has not yet been settled or accounted for in our books, and the mill is currently running well with a strong order book. The decline in the gross profit margin was mainly attributable to lower average recycled containerboard prices due to a high proportion of exports and rolled pulp sales in that business. The margin did improve in the second half as a result of increased demand for containerboard in the domestic market during the last quarter especially, and some recovery in businesses affected by the strict COVID lockdown during the first half. EBITDA for the last quarter of the year was the highest on record, resulting in full year EBITDA of 1.17 billion and underlying operating profit of 631 million rand for the group. Lower average net debt and interest rates reduced net finance costs by 31%, and the effective tax rate of 18% is lower than the statutory rate, mainly due to tax incentives. Underlying earnings per share increased by 4.6% to 201 cents. Mpact generated strong cash flows of 1.9 billion rand from operations, which resulted in net debt decreasing to 1.4 billion and gearing to 27%, down from 38% last year. Return on capital employed was 11.4%. Given the 345 million rand returned to shareholders through the share buyback, no dividend has been declared for the year, and Brett will cover the dividends in more detail a bit later in the share buyback. Moving on now to the segmental reports, and I'm going to start with paper. Revenue of 8.7 billion rand in the paper business was marginally lower than the prior year, with external volumes decreasing by about 3%. There we saw a decline in the paper converting and recycling businesses, partly offset by an increase in the containerboard exports that I mentioned earlier. Demand for containerboard and cartonboard improved notably from the fourth quarter and remains strong today. Sales volumes of containerboard and cartonboard for the year increased 13%, with the exports offsetting a drop in domestic sales. Rolled pulp sales totaled about 21,000 tons, and all of that was in the first half of the year. And as I mentioned at the interim results period, rolled pulp is substantially lower priced than containerboard and cartonboard products. So that had quite a big impact on the margin in this business. Paper converting sales volumes for the fruit sector showed good growth, but this was offset by lower industrial sales due to the lockdown restrictions, resulting in a 6% decline overall in paper converting. External recycling sales volumes decreased by 29% because of lower volumes in plastics and glass, especially with a ban on alcohol. The glass sector was under tremendous pressure. But I should just mention that this didn't have a material impact on the profitability of the business. Underlying operating profit for the paper business declined to 578 million rand due to lower containerboard margins, the effects of lockdown, and the electricity interruptions that I mentioned at the beginning of the presentation. Moving on now to the plastics segment. Revenue in our plastics business was up 3.5% to 2.5 billion rand due to good growth in bins, crates, and FMCG. Overall sales volumes decreased 2.7%, while average selling prices increased by 6.2%, due primarily to product mix. Bins and crates benefited from robust demand in the fruit and bottling segments, while the FMCG business saw good growth in pharmaceutical, food, personal care, and home care segments, which I think we've seen with most of the FMCG companies publishing results recently. Sales of preforms and closures decreased significantly during the year, and that reflected sectoral declines in smaller pack sizes for carbonated soft drinks as consumers stayed home and bought more family pack sizes like 2 liters and bigger bottles. Although volumes declined on the prior year in trays and films, they were up on the plan and reflected a more profitable mix. This is in line with a successful restructuring of the business in 2019, and they've shown great improvement, especially in the last quarter, and that's continued into the first couple of months of this year as well. Underlying operating profit increased by 44% in the plastics business to 119 million rand, with all the businesses other than preforms and closures reporting good improvements, especially in the second half of the year. Included in the result for plastics in terms of operating profit is non-recurring inventory write-off of 29 million rand. I'm now going to hand over to Brett, who will take you through the financial results in more detail, and then I'll come back and talk about the outlook and just give some slides, present some slides showing you some of the progress on the projects that I mentioned earlier. Over to you, Brett.
Good afternoon, and thank you, Bruce. Variable cost of sales. While revenue was at similar levels to the prior year, total variable cost from continuing operations increased by 3.1%. As such, gross profit margins reduced by 1.8 percentage points to 36.1%. Looking at the graph on the top right-hand side, which reflects international benchmark recovered paper prices, global OCC prices jumped in the first quarter off a low base due to shortages in supply caused by the global COVID-19 lockdowns. In South Africa, OCC prices reduced in the first quarter and increased consistently for the balance of the year, with average prices for the period being at similar levels. Fixed costs. Impact's fixed costs decreased by 2.9%, primarily due to depreciation being lower by 17% as a result of the impairment of plant and equipment in the prior year. Net operating expenses reduced in the current period by 3.5% due to stringent cost controls and lower bad debt provisions in 2020. Financial review. While the underlying operating profit before tax was down 4.7%, the benefit of the lower effective tax rate resulted in underlying earnings increasing by 3.6% to 340 million. Underlying earnings per share of 200.6 cents increased by 4.6% due to improved underlying earnings and the benefit of the share buyback. ROCE and net debt. Return on capital employed of 11.4% reflects the decrease in profits partly offset by the improved capital employed. The group's net debt at the 31st of December closed at 1.4 billion, a decrease of 884 million from the prior year. This reflects a strong cash flow generated from operations and strict working capital management. The record cash flow generation for the period reduced gearing from 38% 0.2% to 26.6%. Debt facilities. In the prior year, we took advantage of the buoyant debt markets and refinanced all of Impact's term debt facilities at competitive rates. With the comfort of having these borrowing facilities in place and the benefits of the strong cash generation for the period, Mpact has been able to invest 518 million in property, plant and equipment during the period, in addition to implementing a share buyback of 345 million at the time when many other companies have been under financial stress. The table below reflects Impact's debt covenants, which specifically exclude IFRS 16 lease liabilities from any covenant calculations. The interest cover ratio achieved on our debt covenants was 7.1 times and net debt to EBITDA ratio of 0.9 times. Net finance costs and net debt. Looking at the second line on the table, average net debt, including IFRS 16 lease liabilities, decreased by 19% to 2.1 billion. The lower average net debt, coupled with the benefits of lower interest rates, meant that net finance costs for the period decreased by 31% to 169 million. Working capital. The group benefited from the interventions taken during the period to reduce working capital wherever possible and to only produce on confirmed orders. The key initiative resulted in trade working capital decreasing by 563 million. Trade working capital as a percentage of revenue reduced by 5.1 percentage points to 16.6%. Movements in net debt. Mpact generated 1.2 billion in cash from operations before working capital. This, together with the reduction in working capital, resulted in net debt at the 31st of December, reducing by 38.6% to close at 1.4 billion. Despite investing 518 million in capital expenditure and paying 232 million to capital providers over the period. Taxation. Taxation before special items. A key focus has been to make sure that wherever possible, new capital projects qualify for government tax incentives. During the past year, Mpact has obtained Section 12I and 12L tax incentives on projects exceeding 1.5 billion, resulting in net cash savings to the group of over 200 million. During the period under review, Mpact once again benefited from the 12I and 12L incentives, thereby reducing its effective tax rate to 18.4%. As the benefits of the above tax incentives are coming to an end, Impact's tax rate is anticipated to normalize going forward closer to the 28% statutory rate. Mpact does, however, have a gross assessed loss at the 31st of December of 473 million. Capital expenditure cash flows. Due to the economic uncertainties in 2020, capital expenditure in both the paper and plastics division was limited to essential projects. We did, however, continue with our strategy of acquiring properties and invested over 200 million in 3 properties, 2 of which were previously rented by Mpact. The fair value of land and buildings for the group is now approximately 1 billion rand. Dividends and share repurchases. Following the company receiving a 99.9% shareholder support for the decision to buy back shares at its special general meeting, Mpact repurchased 14.5% of its issued share capital between September 2020 and January this year. This translated to 25 million shares being repurchased at an average purchase price of 13.71 rand per share. The total cash outflow for the shares purchased was 345 million and is anticipated to enhance our earnings per share by at least 10% going forward. The board reviews capital allocation on an ongoing basis, and given Mpact shares were trading at a discount to the intrinsic value, the board is of the view that the substantial share repurchase program enhances value creation for its shareholders over cash dividend. The board has therefore not declared a dividend for the financial year ended 31 December 2020. The board will continue to focus on driving long-term value for shareholders. This is done through prudent capital allocation in the context of growth opportunities which exist and cash returns to shareholders through dividends, share buybacks, or a combination thereof. Thank you, and I'd like to hand you over to Bruce.
Thank you, Brett. Moving on now to the outlook. Mpact has had a positive start to the year, and we feel that we're very well positioned despite a weak economy. There are also good indications of good fruit crops and a gradual recovery in the sectors that have been affected by lockdowns for most part of last year and early this year. We also expect to benefit from an improved global outlook for containerboard and cartonboard in the year ahead. Working capital management will remain a key focus area. We do, however, anticipate that levels will increase as the supply chain is replenished throughout. Our responsible approach to managing costs, creating shareholder value, disciplined capital investment, and a strategic commitment to sustainability will ensure our business remains resilient while being well positioned for growth, both this year and in future. We as a group have a robust strategy with a strong balance sheet, substantial funding facilities, and an experienced, resilient management team to navigate and prosper in this volatile trading environment. That concludes the results presentation. I will now go into some slides just showing the various projects, and after that we'll happily take your questions. Thank you. Despite the prevailing trading conditions, which have been very difficult as we've all spoken about, we have been securely anchored in our purpose of providing our customers with sustainable packaging and giving true effect to the circular economy through our integrated business model. The values of our business are to be trustworthy, resilient, and responsible, and I think the past year has shown that. Because through all of this time, we haven't stopped developing our projects, we haven't stopped our product developments, and we haven't stopped really taking to our customers what we believe will help them to enhance and to further their business interests. And hopefully in the slides that follow, you'll see some of those examples. Our strategy is based on 3 key pillars, and that has been consistent. The first one is leading market positions, the second one is customer focus, and the third is a distinct focus on performance. And through these next slides, you'll see how these manifest in the business on a day-to-day basis. For example, we won 9 Gold Pack Awards, as I may have mentioned during the presentation, for various products, both innovative and some reflecting our response to COVID. And you can see those on the slides. I won't go through them, but they include plastic and paper, of course, both lines of products. On the bottom right slide, you'll see the latest award we got in the last couple of weeks, which is an award for introducing the first 100% recycled PET punnet into the market for grapes and other fruit in South Africa. And that's become a huge benefit for our export customers who are required to have a high percentage of recycled PET in the punnets for them to be accepted in the European market. So another accolade of which we are very proud. If we continue to look at punnets, I did mention at the half year that we've introduced a new brand, Mpact, and this represents basically our efforts in paper-based punnets to offer our clients alternatives to the plastic punnets. And as you'll see in the slides that follow, those have been very, very enthusiastically adopted and welcomed by consumers across the board. These punnets have shown themselves to be extremely effective in the role that they play, not only in protecting the produce, but also in presenting that produce both in the local market, but also in the export markets. And recently we sent a trial of a very new development, which I won't share the details of now, that will be in Europe soon, and hopefully that will lead to more excitement among our customers around some of the products that are coming through in this paper-based tray range called Mpact. And on the next slide, you'll see some more examples of this product. And those of you who shop at the various retail outlets in South Africa, I'm sure many of you would have seen these in your kitchen already, performing and really very exciting products that we are very proud of. and have been developed fully in-house with many different designs. Then, of course, I spoke earlier about some of the investment projects that we've been busy doing in our business. COVID has been a time to stop and reflect, but it hasn't been a time to stop investing because, the future is coming and we'll be prepared, and we are prepared. The first slide that you see there is our investment in solar power at our factories. So as things stand now, last year we invested we commissioned another solar facility, bringing our total investments in solar now to 2.8 megawatts. As I mentioned earlier, by the end of next year, we hope to be above 7 megawatts of solar power across our business. In fact, every business, every property that we own, we are considering for solar power, and we have quite a comprehensive program in this regard. It's not necessarily for security of supply. It's really around the cost impact and also the environmental impact. And we're very proud of the way we're being able to do this across our business. The next slide shows the printer that we've recently commissioned in Mpact, which gives us a tremendous capability now to offer our customers even better quality than what they're already getting, but also increased throughput, which is very exciting, and state of the art. So this is a project that it's already running, but the final finishing touches not quite done yet. But a very exciting project, and one that puts Mpact also on a good footing to continue developing its markets and really satisfying its customers' needs. The next slide shows a new central distribution center that we've been developing over the last 3 years in Ekurhuleni, and specifically next door to our Springs paper factory. Now, to many of you, this might just look like an open slab with a couple of bales of paper on. But for us, it's an essential link in our recycling network, not only to store paper, but to enable us to absorb the paper that is required to be stored in times of low markets, like last year when we saw the recycled market really being under pressure, with a complete oversupply. We are able to use this center to allow us to keep the waste pickers and other collectors in business when otherwise they would have closed because there was no storage space. This project cost 80 million rand over the 3 phases. It's got state-of-the-art fire defenses with cameras and all that go with it. It's got a refurbished and a revamped baling operation, and also a very sophisticated buyback center servicing our customers and suppliers in that area. So another link in the recycling network enabling us as a business to really close the loop and bring about the circular economy. The next slide just shows a different perspective of that same facility, as you can see there in Springs. And similarly, the next slide, you'll see another aerial view which shows the extent of the operation. To many of you, it might not mean a lot, but in the context of our business, this is a key link to sustainability of supply of recovered fiber, and also making sure that it's not wasted or damaged, and you end up using a lot more. I mentioned earlier the investment that Delisio Holdings has made at our Piet Retief paper mill. Delisio Holdings is a black-owned business owned by 2 former employees. We're a minority shareholder as Mpact in that business. They have developed a sodium sulfate processing plant in Piet Retief that you'll see on the next slide. Sodium sulfate is used in the production of, for example, detergents and glass and things like that. It is a byproduct from our paper mill in Piet Retief. And this plant is going to purify it to a level which allows us to get a much better price for it, and also to move it more readily into the market. The plant was commissioned towards the end of last year, very successfully. It was designed by partners of ours. It's not an off-the-shelf technology, and it's proven itself. The products have been accepted by our customers, and the first loads have already been sold. We've already signed up 2 customers who are very enthusiastic to move it into the local market, and we've had commercial production and commercial sales from the 1st of March. So very exciting. And on the next slide, you'll see the trucks of Delisio's in partnership, of course, developed with Super Group, and those are currently being loaded as we speak, which you'll also see on the next slide. So, people are talking about the scorecard. People are talking about a whole lot of things in terms of empowerment, but this is a business, and it's a legitimate, solid business. Our colleagues in Delisio have been out the last 3 years really developing, first of all, their dust suppressant business, which is doing very well. In 2019, they were recognized by President Ramaphosa for the best greenfields project, which in fact is this project, which is now commissioned. And we're all very excited about what it enables us to do in our Piet Retief mill, and also develop, of course, a new business stream for Dalisu. The next aspect is a video related to the construction of the plant with some background information.
Dalisu Holdings Pty Limited, a majority black-owned entity, has successfully completed the construction of a greenfield project worth 254 million rand in Piet Retief, Mpumalanga. Dalisu, which specializes in the commercialization and marketing of dust suppression products within the mining industry, is headed by two executive directors, Dr. Nathi Ngobo and Mr. Mushomi Motobi. The project included the construction of a detergent-grade sodium sulfate plant, which produces highly purified sodium sulfate for the detergent and glass industries. With 50% of South Africa's detergent-grade sodium sulfate currently being imported, and Dalisu being the only local manufacturer and a distributor of purified sodium sulfate, the plant establishes a local manufacturing capability that can over time displace imports. The plant has been commissioned and its acceptance test has been completed, paving the way for commercial production to commence on the 1st of March 2021. The plant has a staff complement of 24 full-time employees and 12 contract workers. During construction, the project created just over 350 jobs, with nearly 40% of those employed being locals.